The Congressional Budget Office is projecting that the deficit will shrink to its lowest level in the last 6 years. Director Douglas Elmendorf held a press conference on Monday to release the CBO's updated budget projections through 2025. This is an hour.
Hello, I'm Doug Elmendorf, the Director of the Congressional Budget Office. CBO has just released its outlook for the budget and the economy over the next 10 years. I will summarize the report briefly, and then my colleagues and I will be happy to take your questions. The federal budget deficit, which has fallen sharply during the past few years, is projected to hold steady relative to the size of the economy through 2018. Beyond that point, however, the gap between spending and revenue is projected to grow, further increasing federal debt relative to the size of the economy, which is already historically high. Those projections are based on the assumption that current laws governing taxes and spending will generally remain the same, and they are built upon our economic forecast. According to that forecast, the economy will expand at a solid pace in 2015 and for the next few years, to the point that the gap between the nation's output and its potential or maximum sustainable output will be essentially eliminated by the end of 2017. As a result, the unemployment rate will fall a little further, and more people will be encouraged to enter or stay in the labor force. Beyond 2017, we project, inflation-adjusted gross domestic product, or real GDP, will grow at a rate that is notably less than the average growth during the 1980s and 1990s. Let me address the budget outlook first, and then turn to the economic outlook. We estimate that the deficit for fiscal year 2015 will amount to $468 billion, slightly less than the deficit for 2014. At 2.6% of GDP, this year's deficit is projected to be the smallest relative to the nation's output since 2007, but close to the 2.7% that deficits have averaged over the past 50 years. Although the deficits in our baseline projections remain roughly stable as a percentage of GDP through 2018, they rise after that. The deficit in 2025 is projected to be $1.1 trillion, or 4.0% of GDP, and cumulative deficits over the 2016 to 2025 period are projected to total $7.6 trillion. We expect that federal debt held by the public will amount to 74% of GDP at the end of this fiscal year, more than twice what it was at the end of 2007, and higher than in any year since 1950. By 2025, in our baseline projections, federal debt rises to nearly 79% of GDP. When CBO last issued long-term budget projections in the summer, we projected that under current law, debt would exceed 100% of GDP 25 years from now, and would continue on an upward trajectory thereafter. That trend could not be sustained. Such a large and growing federal debt would have serious negative consequences, including increasing federal spending for interest payments, restraining economic growth in the long term, giving policymakers less flexibility to respond to unexpected economic events, and eventually heightening the risk of a fiscal crisis. Why will deficits and debt increase relative to GDP under current law? In our projections, outlays rise from a little more than 20% of GDP this year, which is about what federal spending has averaged over the past 50 years, to a little more than 22% in 2025. Four key factors underlie that increase: the retirement of the baby boom generation, the expansion of federal subsidies for health insurance, increasing health care costs per beneficiary, and rising interest rates on federal debt. Consequently, under current law, spending would grow faster than the economy for Social Security, for the major health care programs, including Medicare, Medicaid, and subsidies offered through insurance exchanges, and for net interest costs. In sharp contrast, mandatory spending other than that for Social Security and health care, as well as both defense and non-defense discretionary spending, which shrink relative to the size of the economy. By 2019, outlays in those three latter categories taken together would fall below the percentage of GDP they were between 1998 and 2001, when such spending was the lowest since at least 1940, the earliest year for which comparable data have been reported. Revenues are projected to rise significantly by 2016, buoyed by the expiration of several provisions that reduced tax liabilities and by the ongoing economic expansion. In our projections, based on current law, revenues equal about 18.5% of GDP in 2016 and remain between 18 and 18.5% throughout the coming decade. Revenues at that level would represent a greater share of the economy than their 50-year average of about 17.5% of GDP, but would still be less than outlays by growing amounts over the course of the decade. Revenues from individual income taxes are expected to rise relative to GDP, mostly because people's income will move into higher tax brackets as income gains outpace inflation, to which those brackets are indexed. But those increases are expected to be offset by reductions relative to GDP in revenues from the corporate income tax and other sources. Turning from the budget to the economy, we anticipate that economic activity will expand at a solid pace in 2015 and the next few years, reducing the amount of underused resources, or slack, in the economy. In our estimation, increases in consumer spending, business investment, and residential investment will drive the economic expansion this year and over the next few years. The growth in those categories of spending will derive mainly from increases in hourly compensation, from rising wealth, from the recent decline in crude oil prices, and from a step-up in the rate of household formation. As measured by the change from the fourth quarter of the previous year, real GDP will grow by about 3% in 2015 and 16, and by 2.5% in 2017, we expect. The difference between actual GDP and our estimate of potential GDP, which is a measure of slack for the whole economy, was about 2% of potential GDP at the end of 2014. During the next few years, we expect, actual GDP will rise more rapidly than its potential, gradually eliminating that slack. For the labor market in particular, we anticipate that slack will dissipate by the end of 2017. By our projections, increased hiring will reduce the unemployment rate from 5.7% in the fourth quarter of last year to 5.3% in the fourth quarter of 2017, which is close to the expected natural rate of unemployment, that is, the rate arising from all sources except fluctuations in the overall demand for goods and services. That increased hiring will also encourage more people to enter or stay in the labor force, boosting the labor force participation rate, which is the percentage of people who are working or actively looking for work. Our projections beyond the next few years are not based on estimates of cyclical developments in the economy, because the agency does not attempt to predict economic fluctuations that far into the future. Instead, those projections are based on estimates of underlying factors that affect the economy's productive capacity. For 2020 through 2025, we project that real GDP will grow by an average of 2.2% per year, a rate that matches the agency's estimate of the potential growth of the economy in those years. Potential output is expected to grow much more slowly than it did during the 1980s and 1990s, primarily because the labor force is anticipated to expand more slowly than it did then. Growth in the potential labor force will be held down by the ongoing retirement of the baby boomers, by a relatively stable labor force participation rate among working-age women after sharp increases from the 1960s to the mid-1990s, and by federal tax and spending policies set in current law. The elimination of slack in the economy will eventually remove the downward pressure on the rate of inflation and on interest rates that has existed in the past several years. By our estimates, the rate of inflation, as measured by the price index for personal consumption expenditures, will move up gradually to the Federal Reserve's goal of 2%, hitting that mark in the end of 2017 and beyond. Interest rates on Treasury securities, which have been exceptionally low since the recession, will rise considerably in the next few years, we expect, but remain lower than they were on average in previous decades. Between 2020 and 2025, the projected interest rates on 3-month Treasury bills and 10-year Treasury notes are 3.4% and 4.6%, respectively. Thank you. We're happy to take your questions. Please start by identifying yourself and the publication you work for. Well, that should be easy. Yes.
William Hall from Tax Notes today. Did any of your projections include these dynamic scoring methodology?
So our baseline economic projections and our baseline budget projections are consistent with each other in that the budget projections are what we think will happen to the federal budget given the economic outcomes we predict, and the economic outcomes we predict are those that we expect would happen given the baseline budget projections. So the baseline projections are always dynamic, I think, in the sense in which you mean that word, in that the budget and the economic effects are calculated, projected together.
If I may, I guess I'm using the term specifically as it's met by people in Congress who have been active in that area recently.
Well, the interest of people in Congress is generally focused on our cost estimates, not on the baseline projections. For cost estimates, there has been a very long-standing custom that cost estimates by CBO or the revenue estimates by the staff of the Joint Committee on Taxation have not included the effects of the proposals on overall macroeconomic conditions and the feedback from those macroeconomic changes to the federal budget. However, we and JCT have produced estimates of the economic effects of large proposals periodically over time and reported those to the Congress. For example, nearly every year we do an analysis of the President's budget that starts with an estimate of the effects of the specific spending and revenue provisions without allowing the macroeconomic conditions to change. But then we go back and do an economic analysis of the President's budget, including the feedback then to the budget itself. And we have done that essentially every year for a dozen years. We also do that sort of dynamic analysis when we do different paths for federal debt in the long-term budget outlook. We did it for the comprehensive immigration legislation considered in the Senate a few years ago. And our colleagues at JCT have done it for a number of pieces of tax legislation, including, for example, Chairman Camp's tax reform proposal last year. So we and JCT are accustomed to doing analyses of the economic effects of major pieces of legislation. What is different in the rule that the House has adopted is that the budgetary feedback of those economic changes would be included in the official cost estimate rather than being presented as supplementary information, which is the way it has been done in some cases in the past. And we are prepared to do what the House rule asks us to do. Jonathan.
John Middleton, Bloomberg DNA. Two things. One, you had some verbiage in there about interest cost, and there's often a concern that those will skyrocket. Can you give us a little rundown of where you guys see what Treasury's going to be paying for its debt? And then also, can you talk a little bit about wage growth? How much of that slowing wage growth is basically for people, for lack of a better term, being cowed, being still worried about losing their job and not being able to get a new job because seems to be people out of work for so long.
So on the first question about interest payments, as you know, interest rates on Treasury debt have been extraordinarily low for the past several years. And as a consequence of that, even though federal debt is historically high relative to the size of the economy, interest payments by the government have been quite low. So interest payments this year, 2015, we project will be $227 billion. That's just 1.3% of GDP, well below what interest payments were, say, 25 years ago. But over the coming decade, we expect that interest rates will move up considerably. And as the Treasury needs to finance new deficits and as it rolls over the existing debt, then the interest rate that it pays on average on the outstanding debt will rise. And with debt as high as it is, and with the rise in interest rates, interest payments rise considerably. So in nominal dollars, we expect the interest payments that As I say, this year we think will be $227 billion. We think will be $827 billion in 2025. And that'll be 3% of GDP rather than the 1.3% that they will be this year. As for wage growth, compensation growth since the recession has been a good deal lower than it was before the recession. And although some measures have picked up a little bit last year, they still remain well below what we saw before the recession. And we think that is a direct consequence of the slack in the labor market. When employers are trying to attract workers, if there are a lot of people looking for jobs, then the employers don't have to offer as high pay as they would if the labor market were tighter. So we think that as the labor market has tightened, and we think will continue to tighten over the next few years, we think that will put more pressure on employers to raise compensation. And we think the compensation growth will pick up. Now, the share of national income going to labor has fallen quite a bit over the last few decades. And we think it will rebound, but not to the level that it was 15, 20, 25, 30 years ago.
Do you think it's going to be a permanent structural change of the share between labor and capital?
We think there have been permanent structural changes. But knowing how important those will be in the future is, of course, very hard. Certain technological changes, globalization are the forces that people look to a lot. But there are probably others that have been at work as well. And how important those factors will be in the future is very hard for us to know. The labor share of income tends to fall during the initial recovery from recessions. So I think we have a good basis for expecting that it will come back some from where it is now. But how far back it will come is hard to know. And we have done is to project that it comes back part way toward its average of the previous few decades. Yes.
Paul Krosniak, CQ roll call. Two-part question on dynamic scoring. So number one, do you have a view on whether the House rule on dynamic scoring is a good idea? And number two, will there be a greater level of uncertainty to a dynamic score under this House rule compared to the conventional score under the House rule?
We don't have a position about whether the House rule is a good idea or not. We think it's natural for the members of Congress to be interested in the macroeconomic consequences of major pieces of legislation. And that's why CBO has for many years built models to estimate those macroeconomic consequences. And we have in the past few years devoted a great deal of effort to improving those models, to getting feedback from outside experts, revisiting the key assumptions, and then to writing a collection of papers that spell out how we do analysis of the macroeconomic effects of changes in fiscal policy. I think there's really, at this point, a set of 8 papers that go through the key aspects of that modeling, one of which was about a dozen years old, but the other 7 of which I think we've written in the past 3 or 4 years. So we've always understood the importance of that kind of analysis to the Congress, and we're doing our best to provide the best estimates that we can. But it's really up to the Congress to decide how it wants to use that information. And if it wants that information to come in a supplementary form, not in the official cost estimates as it has in the past, then we are happy to do that. And if the Congress wants that extra set of estimates to be included in the official cost estimates, as the House rule now requires for certain legislation, then we are happy to do that. It's up to the Congress to decide the form in which it wants to receive our analysis. As for uncertainty, the macroeconomic effects of legislation are often quite uncertain. It is also true that the non-macroeconomic effects of legislation can be quite uncertain. And I think it's always important for readers of our work to understand that there is a great deal of uncertainty surrounding the numbers, and we give point estimates because the budget process basically requires point estimates. Things have to add up. Allocations are given to committees. Certain amounts of money are appropriated. So we try to work in that world, but we understand, and we hope that our readers understand, that there's always a great deal of uncertainty. In some cases, the macroeconomic effects of legislation will be more uncertain than the effects we estimate holding the macroeconomic conditions fixed. But I think that won't always be the case. It really depends on the legislation that we're analyzing. As a general matter, legislation that makes small changes in programs or in the tax code, speaking for JCT, small changes of the sort that have been done before, analysts have a reasonable basis for making fairly accurate projections. But for major changes in policies, for a comprehensive reform of the tax code or of our immigration policies or of our health insurance system, then there's always a great deal of uncertainty that accompanies the estimates that we provide for that as well. And I think that's just a general feature that people need to understand and that we need to continue to convey as clearly as we can. And for a number of our macroeconomic analyses, we have provided ranges of the macroeconomic effects in addition to a central estimate to try to convey very clearly the uncertainty that those estimates have. Robert.
Please talk a little bit
Robert Pear from the
New York Times. Could you please talk about changes in CBO's estimate of major healthcare programs since CBO's update in August 2014?
Yes. So let me talk. There are a few components of the major healthcare programs I think worth discussing. For the coverage provisions of the Affordable Care Act, and to be clear what we mean by that, the Affordable Care Act changed a lot of features of spending programs in the tax code. We generally talk about them in a few large buckets, one being the provisions that expanded health insurance coverage, like the expansion of Medicaid and the offering of the subsidies through insurance exchanges and the related provisions. There are other provisions mostly involving large changes to the Medicare program and significant changes to the tax code. The provisions I'll focus on now are the ones involving the expansion of health insurance. For those provisions, we have made a significant downward revision to the estimated cost over the next decade, a downward revision of about $100 billion. I think it's 7% less than we expected last year. And relative to our projections in March of 2010, when the Affordable Care Act was enacted, the cost of those insurance coverage provisions between 2015 and 2019, which was the last 5 years which we made estimates in 2010, for those 5 years, 2015 to 2019, we've now revised down the cost of the insurance coverage provisions by about 20%. And that's been through a collection of revisions multiple times a year over the past 5 years. There are a number of factors that underlie that set of revisions. Probably the most important one is a slowing in growth of health insurance premiums. But there are others as well, including, for example, the Supreme Court decision of a few years ago and many other external factors and improvements in our modeling. We also, as you know, Robert, have revised down over the past several years our projections for Medicaid and Medicare spending a good deal. There's a further down revision in Medicaid spending in this set of projections, and there are a number of factors that have fed into that. There are, apart from economic changes, for Medicare, there have not been significant changes in this projection relative to the last one, apart from some things that relate to the economic forecast. But in terms of what we consider technical revisions that are not due to legislation or changes in overall economic conditions, but are focused on developments in the programs and our interpretation of them, we did not make a significant downward revision for that reason to the Medicare projection this time. But all told, since 2010, because of these technical factors, this assessment of what's going on in healthcare programs, we have marked down our projection of federal Medicare spending, federal Medicaid spending, and premiums in the insurance exchanges by about 15% each for, say, 2020. So some of that is things that have happened already, and some of that is our projection of slower growth over the next few years. So we've gone a little further in that direction this time in our projection of the health insurance subsidies and the cost of the ACA expansion and in Medicaid. No further this time, really, in Medicare. Robert.
Bob Samuelson, Washington Post. You have figures on the decline in discretionary spending, both domestic and defense, as a share of GDP. Do you have comparable figures in it adjusted for inflation and for population change? Using a base year, say, before the caps or something like that?
We don't have a continuous series of those. I think there are some spots in the text where we talk about certain components of discretionary spending relative to 4 or 5 years ago, adjusting for inflation. But I don't remember all those numbers offhand. And there are spot references. And I don't think we've reported anything which adjusts for population growth. I'm happy to hem and haw for a moment while I thumb through this, Bob, and see what we can tell you about that. So, for example, between 2010 and 2014, on page 79, between 2010 and 2014, funding for defense declined by 15% in nominal terms, or nearly 21% in constant 2010 dollars. Excluding the funding for overseas contingency operations, defense funding fell by roughly 6% in nominal terms, or 12% in real terms over that period. Also between 2010 and 2014, I'm on the same page, funding for non-defense discretionary programs declined by 4.5% in nominal terms, or almost 11% in constant 2010 dollars. Yes.
Yeah, Nick Timmerose with the Wall Street Journal. I was wondering if you could talk a little bit about what prompted the downward revision on the potential output for the U.S. economy.
Yeah, so we revised down our estimate of potential output by about 1% from what we had in our August economic forecast. And the primary source of that downward revision was a reassessment of productivity growth, and especially productivity growth in the non-farm business sector. We had previously thought that the slow growth of actual productivity, the slow observed growth in productivity over the past several years, was mostly due to a shortfall in growth relative to the potential level of productivity. And we thus anticipated that actual productivity would rebound to its potential level over the coming years. And for some time that seemed like a reasonable expectation because productivity often falls short of its potential level when the economy is weak. When demand for firms' products is weaker, firms don't push the workforces as hard as they do when demand is stronger. So it was reasonable in our view that to have a projection of potential total factor productivity growth in the non-farm business sector that was above the actual growth we were observing. But as the economy has strengthened over the past few years, one would expect that actual growth to not be falling further away from our projection of potential, but it was, given the projection of potential growth that we had. And that didn't seem to us to be the best forecast in an economy that was strengthening. So we lowered our projection of potential total factor productivity growth. So it's still above actual growth. We still think there will be some rebound in productivity over the next few years, but not as large a rebound as we've been expecting before. This is this problem that we face in trying to understand how much of what's happened to productivity over the past several years is due to the business cycle and how much is due to underlying factors is hard, and it becomes harder as the length of time during these weak economic conditions last longer. So there are people whom we cite who've observed that productivity growth seemed to slow for a few years before the recession. That was a pretty short period, and then we had a very deep recession and a slow rebound of output. So it's hard to know how much of what's been going on over these past half dozen years is because the economy has just been weak and will go away as the economy recovers further, and how much is a part of the underlying structural conditions that we face. And on this particular variable, the productivity, we think that the persistent slow growth in the face of an improving economy suggests that more of that slow growth is due to structural problems rather than to the cyclical conditions. And because of that, we've marked down our expectation for productivity growth going forward. Yeah.
Hi, Jim McTigg from Barron's. I have a technical question. On page 98, you talk about the erosion of corporate tax base. Over 2.5% of the erosion in the corporate tax base is due to inversions. See that? It's in the right-hand column.
Yes.
But it says a final factor that partially offsets the effect of the others. We talked about pushing corporate tax revenue up. Is that you expect the average tax rate on domestic profits will be closer to the historic average. Now, what is the domestic economic profit, and how does it differ from the corporate profits? How does it offset the corporate?
I think the way to think about our projection of corporate tax receipts is to start with an economic projection of how much profits we think will be earned by corporations in this country. Because the profits earned in this country are taxed much more than profits of U.S. corporations that are earned overseas. So we focus in this presenting our results on the domestic profits of those companies. And then the question is, well, what share of those profits will be paid in tax? And one can't tell this by looking up just the statutory corporate tax rate, of course, because the tax that's paid depends on the expenses, the deductions, and so on that companies will make and how that will affect their tax burden. What we're trying to explain here is that there's some cross currents. Part of what's going on is that the effective tax rate on domestic profits, which is to say the total amount of money the Treasury has collected, as expressed as a ratio to domestic profits, fell during the recession the last few years in a way that we can't entirely explain. And part of the reason we can't explain it is that all we have now for the last few years is the total amounts of money. The details, what's in the corporate tax returns, will help unravel this puzzle, but they're only available with some lag. So for the last few years, we've seen that this tax rate, really defined as the tax collections divided by profits, has been low. And we think that there will be some recovery in that toward a longer-term average, because we are making an educated guess that what's happened in the last few years is partly because of particular economic circumstances of the past few years. So there'll be some rebound over the next few years from that phenomenon. At the same time, there's a different thing going on, which is that companies are trying to find ways to reduce the corporate tax that they pay. As we explain here, some of what they're doing involves moving business income from the corporate sector to the non-corporate sector, moving them out of C corporations and into S corporations and other things that are not taxed at the corporate level. And we've written about that before. There's been an ongoing downward trend in the share of business income that's taxed at the corporate level. We think that will continue. The second factor we describe is a set of efforts by companies to increase the amount of corporate income that is shifted out of the country, and thus is recorded as having been earned in a different country, and thus subject to much less U.S. tax. There are various ways to do that. We talk about transfer pricing. We also talk about inversions. So corporate inversions are part of the roughly half of the erosion of the corporate tax base that we talk about. And that factor is at work in reducing corporate tax receipts over the coming decade progressively. But that is offset, in part, over the next few years by an increase in the rebound in the tax rate for these other factors that we don't have a firm handle on because we don't have the detailed tax data of the past few years. Moreover, beyond all of that, we think that corporate profits will decline as a share of income later in the decade because rising interest rates will increase their interest payments, and because faster compensation growth that pushes up the labor share of income will push down the corporate share of income. And that factor, which affects essentially the denominator thing we've been talking about, the economic profits, we think that those factors will push economic profits down relative to GDP. And that will also push down corporate tax revenue expressed relative to GDP. And I will check with my folks who are experts and make sure I got that right. Or right enough. Okay. Other questions? Yes.
Bloomberg News. We were just wondering, given the updated revenue and spending outlook, do we have any idea when we're going to be looking at hitting the debt limit this year, assuming Treasury uses extraordinary measures?
Yes, so we do write about that in the report. The debt ceiling was suspended, as you know, through the middle of March of this year. And when that suspension ends, the debt ceiling will, under the law as it now stands, the debt ceiling will be reset to equal the amount where the ceiling was before it was suspended, plus all the debt that has been issued since the debt ceiling was suspended. So when this happens in mid-March, the debt ceiling will be set equal to the outstanding debt subject to limit. So Treasury will immediately, in mid-March, be unable to increase its net borrowing. Then at that point, we presume it will deploy this customary set of, quote, extraordinary measures to obtain funds without increasing debt subject to limit. And we think that those measures will be effective through September or October of this year, at which point we think they will have exhausted their extraordinary measures. Shortly after that, then the Treasury will have run down its cash balance and be unable to meet all of its obligations in a timely way unless some other action is taken. That projection of September or October is, of course, uncertain. It depends on inflows and outflows of money over the next 8 or 9 months. So, and you know from previous rounds of this, projecting the Treasury's cash flows on a month-to-month, week-to-week, day-to-day basis is a very uncertain business. So we will continue to keep the Congress apprised, but we're not likely to know more precisely when the Treasury will run out of extraordinary measures or run out of cash until we get quite close to those events occurring.
Can you go over the major factors causing the deficit to fall over the next couple years and then start rising again?
The deficits?
The deficit.
So let me try. I'm happy to talk about the patterns. So we think that the dollar amount of federal deficits will be, as I said, $468 billion this year, $467 billion next fiscal year, and will then start to rise. Expressed as a share of GDP, the deficit will remain about 2.5% through 2018, and will then rise beyond that, rising from about 2.5% in 2018 to 3% in 2019, and then to 4% by 2025. And that pattern results from the combination of the factors that I talked about earlier. Part of what happens is that tax revenues rise a good deal in 2016 relative to 2015 because of the expiration of some tax provisions and the improving economy. So thex revenues that we think will be 17.7% of GDP this year, we project to be 18.4% of GDP next year. So there's an increase in tax revenues, market increase, even relative to the size of the economy. But after 2016, tax revenues remain about the same relative to the size of the economy for the rest of the decade. So we have tax revenues that move up quickly in 2016, but then are about flat, expressed as a share of GDP. Meanwhile, on the outlay side, there are these various cross currents. The retirement of the baby boomers is exerting this tremendous upward pressure on spending for Social Security and Medicare and Medicaid throughout the decade. There'll be more than 1/3 more people receiving the Medicare and Social Security benefits at the end of the decade than are receiving it today. So that goes on all the time, and that pushes up total spending by the federal government. But at the same time, there are, and the other thing pushing spending up, of course, is rising interest payments. We think interest rates will move up a fair bit over the next few years, but the government's interest costs respond slowly to that because the government doesn't roll over all of its debt in any one year. So the average interest rate that's paid on Treasury debt responds gradually to market interest rates. And we actually report in Table 1.3 on page some page of the report, I don't have the page number, the average interest rate on debt held by the public, which rises throughout the decade. So we have these aging the baby boomers, rising healthcare costs per person, the expansion of the healthcare subsidies, rising interest payments. All those things are pushing spending up throughout the decade. But on the other hand, there are declines in spending relative to GDP for defense purposes and for all other non-defense purposes, both the non-defense discretionary spending, like highway infrastructure, R&D support, education and training support, health research, and veterans health care, many other things, and in the non-Social Security, non-healthcare benefit programs like SNAP and SSI and so on. So the specific pattern of deficits from year to year results from this whole combination of factors. But again, the underlying point is that we have a handful of very large federal programs that provide benefits to older Americans or provide health care benefits, or both. And with a rising number of older Americans and a rising cost of health care, those programs get much more expensive. So by 2025, 1/4 of total projected spending will be for Social Security benefits. And some of the other biggest pieces are Medicare, defense spending, interest payments. If you take just those 4 things alone, Social Security, Medicare, interest payments on the debt, and defense spending, those 4 items together represent 2/3 of total federal spending in 2025. So the growth of federal spending is not coming from a growth across the board in federal programs. It's really coming from growth in a handful of very large programs. But the other parts of the budget, as I said earlier, and we show in the report, are getting smaller relative to the size of GDP. And that damps some of the effects of the growing spending on those items I just highlighted. So it's a combination of these factors, but the trend is clearly for rising deficits for reasons that are very well understood and have been predicted by analysts literally for decades. Yeah.
Hey, David Lauder with Reuters. Just wondering if you could clarify your status here at the CBO. Are you a contender to continue this job with the new chairman?
My current status is to be the director of CBO. My term ended on January 3rd, but under the Budget Act of 1974, directors can continue to serve until after their terms have expired, until new directors are appointed. And I like the job a lot, so I'm continuing to serve, and I expect to do that unless and until a new director is appointed. And whether a different director will be appointed, and if so, who that will be and when that will occur, I don't know, and I'm not going to be the first person to know or the first person to tell you. I think that decision rests with budget committees and the leadership of the House and the Senate. And I'm content to leave it with them, and I think they will speak to the matter when they want to speak to it. Yes.
Hi, Liz Farmer, Governing Magazine. Can you talk about your estimate that by 2039 public debt will exceed 100% of GDP? And you said that's the last time that happened was just after World War II. That was a time of unparalleled economic growth. So can you kind of talk about that concern?
Yeah, so this is a projection from our long-term budget outlook last summer. When we look out 25 years, and in some senses then even longer. So we said last summer that we thought that under current laws, that debt would exceed 100% of GDP within 25 years. We have not formally updated those longer-term projections, but the projection in this report of debt relative to GDP at the end of the decade is quite close to the projection we used last summer in building the longer-term projections. We have not learned anything since last summer that would change our view that unless some significant changes are made in spending or tax policies or both, that debt will exceed 100% of GDP within 25 years and be on an upward trajectory at that point in time. I think, and the only time before in our history where our publicly held debt has been around 100% of GDP was right at the end of the Second World War. What was different then was that the debt ran up very sharply during the Second World War, but then started to come down relative to GDP. That was not particularly because of, I can find that picture, It's not particularly because large surpluses were run, but because, as you mentioned, GDP grew rapidly and the budget was close to being in balance. But the reason for the run-up in debt then was really this particular one-time event, the cost of fighting the war. The run-up in debt we've seen over the past half dozen years is very heavily because of the financial crisis and recession, the weak recovery, and the policy responses to those events. So those are, one hopes, one-time events. But behind that is this ongoing and highly anticipated event of the retirement of the baby boom generation, and thus the movement of a large number of Americans to an age where the federal government provides significant benefits. And also underlying this is the rising cost of health care per person, which has been less over the past half dozen years than it had been for decades before that. But nonetheless, we think the best projection is continued growth in healthcare costs per beneficiary. So with many more people eligible for Social Security and Medicare and certain benefits in Medicaid as time goes on, and with the cost of healthcare benefits rising, we now face a structural, long-term structural challenge that is quite different from the situation faced at the end of the Second World War. And the fact that debt doesn't rise very much relative to GDP over the next decade it does not mean that having debt at this high a level doesn't have significant costs. It does. With debt this high relative to the size of the economy, there will be significant interest payments when interest rates rebound. There will be crowding out of capital investment as time goes on. There was a reduced flexibility for policymakers to respond to future financial crises or recessions or international events. And there's a heightened risk of a fiscal crisis. So even if debt were stable at 70-some% of GDP, there would be significant costs. Moreover, because of these underlying forces, we don't think that the debt will be stable. And another point worth emphasizing is that even the reason that debt only rises a little bit relative to the size of the economy over the coming decade, despite the demographic changes and rising healthcare costs, is really because there is set now into current law a very sharp reduction in spending for everything apart from Social Security and the major healthcare programs compared to the historical experience. Non-defense discretionary spending, this whole collection of programs for which the Congress appropriates money each year, is about the same percentage of GDP this year that it was 50 years ago. And this spending has fluctuated relative to the size of the economy over time, but has shown no evident trend over 50 years. But under current law, given the caps on discretionary funding, it will fall to a lower percentage of GDP than we have seen in at least those 50 years, and it turns out that those data aren't available that way before 50 years ago. Defense spending is a little more complicated. Defense spending has trended down relative to the size of the economy over the last 50 years, although not over the last 20 years. So it fell a fair bit in the 80s, 90s, well, in the end of the 80s, the 90s, and the 2000s. But it has really stabilized the share of GDP over the last 20 years. And what you think the need for that spending will be going forward depends on what you think will happen in the world and what role you think the U.S. should play in international events. But defense spending is also on track to fall to a smaller number relative to the size of the economy than it has been at any point for which we have the data. So there's this very sharp shift underway under current law in what the federal government spends its money on. And because the appropriations process occurs 1 year at a time, the caps have been set without any decisions having been made about exactly which programs or which services won't be provided in the future that would have been provided under the historical experience with those government programs. And we highlight that issue in our report as a risk going forward, that the caps have been set, but the decisions about what will be cut and what will not be cut have not yet been made. Are there other questions? Yes, Bob.
Yeah, can you go back and just talk a little bit more about interest spending, which grows substantially on your projections, and although it's lower than it might have been in the past, it's still substantially higher than it is today. And I'm just wondering whether or not you considered the possibility that interest rates have declined structurally and are going to be lower in the future than anybody would have predicted 4 or 5 years ago, or even predicting today, and what that would do to the outlook for the deficit.
Yes, so as I mentioned, we expect that interest rates will rise considerably from their current levels, but we do not think they will rise up to the levels that they were at over the past few decades. We wrote about this at some length in our long-term budget outlook last summer, and we have a brief discussion of it, brief recapitulation of those arguments in this report. We've done this analysis by thinking about what would be different in the future relative to the 1990 to 2007 period, which was a period of reasonable stability in the economy and in financial markets. And relative to that 1990 to 2007 period, we think that inflation-adjusted Treasury interest rates will be about 3/4 of a percentage point lower in the future than they've been in the past. And that 3/4 of a percentage point difference is pretty substantial, right? We project that nominal 10-year Treasury note rates will be 4.6% by the end of the decade. With CPI inflation of 2.4%, that means an inflation-adjusted 10-year rate of 2.2%. As I say, that compares to about 3% for the real Treasury 10-year rate in the 1990 to 2007 period. So we've made a substantial downward adjustment relative to the past experience. And that adjustment is the net effect of a number of factors, and we list 4 going different directions. The 4 factors that we list pushing down interest rates relative to the history are, number 1, slower growth of the labor force. Number 2, slower growth of productivity. And both of those factors, we think, lower interest rates because they basically affect the marginal product of capital in the production process. We also think that greater income inequality is pushing up saving, which tends to lower interest rates. And we think there'll be a greater risk premium on private securities, which is to say that Treasury rates will be held down because of a greater demand for safe assets. Those 4 factors alone would have argued for a larger downward revision in our interest rate projection than we've made. But on the other side, are 4 other factors that we think will push up interest rates relative to the experience of the previous few decades. One of those is greater federal debt. Another one is slightly smaller capital inflows from overseas. And third is fewer people in their prime saving years. This is just another way of saying the baby boomers are moving into to the older ages, so fewer people in their prime saving years. And fourth, a higher capital share of income argues for higher return to capital and thus a higher return on Treasury securities that compete with capital for investors. So as best we can judge, the 4 factors pushing down rates relative to the historical experience will be more powerful than those pushing up rates by a good deal, and that's why we've made this downward revision relative to the history. But nonetheless, we think that rates will move up a good deal from where they are now. And that is consistent, we think, with what the expectations of participants in financial markets and consistent with our own modeling of the demand for funds as the economy strengthens. And again, these are changes we mostly made last summer in the long-term budget outlook and incorporated into our August projections. We made a further small downward nudge to interest rates in this projection, basically because of a decline in interest rates in other countries that makes U.S. assets relatively more attractive, and then we think pulls more money into this country. This is no doubt one of the sources of great uncertainty in our projections, and we offer in an appendix to the report rules of thumb for how the budget projections would be different if our economic projections were different. We offer rules of thumb for faster or slower growth in real GDP, for higher or lower inflation, and for higher or lower interest rates. And not surprisingly, budget outcomes are quite sensitive to interest rates. And that's much more true than it would have been, say, a decade ago, because debt is so much larger than it was a decade ago. So I think we have balanced the risks in this projection, but the risks on both sides are considerable. Yes?
Getting back to healthcare for a second, you've talked about it a little bit, but just trying to get a better handle on it, about subsidies for people in the exchanges, and you reduced a little bit of your outlook for that. And that seems to be based on, I guess, basically a 1 year of experience, of actual hard experience on that front. Now, I guess, given the amount of time that's passed, it's gone on since the passage of the ACA to its implementation, or its partial implementation, how confident do you feel about your original score and things like the subsidies, and to that extent also about the Cadillac tax, which seems to be the major piece that still has yet to be implemented?
You're absolutely right to say that we've only observed exchange enrollment, exchange subsidies, the increment to Medicaid enrollment from the people who are newly eligible and the cost of those people for a year. And we don't have even such detailed data in all cases for what's happened over that year. I think we'll learn a good deal more in the years to come. On the other hand, the sources of the revisions to the projection that we made since 2010, I think have more foundation than just looking at last year would suggest, because part of what we've done here is to take on board information about private health insurance premiums over the 5 years since we did these estimates in 2010. And it is true that insurance premiums, private insurance premiums, could jump up next year. They could fall next year. They could rise by a small amount next year. There is a lot of uncertainty about that. But we have seen now a number of years of significantly slower growth in private health insurance premiums than we had expected in 2010. And that including the premiums that were paid in the insurance exchanges last year, and the premiums that we see for coverage in 2015. So I think we have a strong basis for making a significant downward revision to the projected cost of the subsidies offered through insurance exchanges. Although whether we have that amount precisely right now, of course we don't know. And I think similarly for Medicaid, we have now seen a number of years of slower growth in Medicaid costs per beneficiary than we had expected in 2010. So although there are particular aspects of the Affordable Care Act that we've only observed 1 year for, we've observed the slower growth in Medicaid spending for some time. So again, I think we have a much stronger foundation for this cumulative set of downward revisions to the cost of the Medicaid part of the ACA expansion than just from looking at last year's data, although once again there, considerable uncertainty remains.
And on the Cadillac tax, about how important that is moving forward to these estimates?
Well, as you know, the excise tax on high premium insurance plans has not yet taken effect. So it is particularly hard to, we don't even have the 1 year in that sense. There is anecdotal evidence. People report making adjustments to their plans to keep premiums on a trajectory below what they think will be subject to that tax. But those are just anecdotes at this point, as far as I'm aware. We expected and continue to expect that most of that there will be a significant adjustment by employers to try to keep premiums for plans below the thresholds that will subject them to this tax. So of the total revenue that we show occurring because of this tax, I think only a quarter of it we expect will actually come in the form of excise tax receipts. The other 3/4 of extra revenue comes in our projections because employers hold down premiums and therefore pay more in cash compensation to their employees because they'll be paying less than they would otherwise in this non-taxed compensation of health insurance. So the extra cash compensation will yield higher tax revenues. So 3/4 of these revenues are actually will never show up as revenues for the excise tax. They will nonetheless occur, we think, because of the excise tax, because that tax will induce a behavioral response that we've taken on board in these projections that we've done with our colleagues at the Joint Committee on Taxation. So we don't know what that will yield, and it is true that all else equal, slower growth of health insurance premiums in the economy as a whole may make it easier for firms to stay below those thresholds, but all else is not equal. Lots of other things are going on, and we incorporate all those factors in making our projections.
One follow-up, if I could. Just you popularized the term, whether you wanted to or not, of bending, or actually your predecessor popularized the term, bending the curve. We've had 5 years now, and you feel relatively confident about your projections at this point. How good of a job do you think ACA has done of bending the curve of national health expenditures?
We don't know. The reason that we've shied away from using the term bending the curve is because we think people tend to view it as a permanent state of affairs. What we do know is that the curve, meaning both federal health costs and national health costs, has been flatter over the past several years than we or most people anticipated 5 years ago or 10 years ago. So the curve has been flatter. Whether it has flattened and we think it will stay flatter for a little while than we had thought before. But our projections don't show it being this much flatter indefinitely. We think there will be somewhat faster growth in healthcare costs again later in the decade. But we don't know. That we're trying to balance the risks of putting too much weight on a phenomenon that's gone on for a little while, or putting too little weight on something that's gone on for a little while. But there's a further question in your question, which is, well, given that these curves have been flatter over the past several years, how much of that is attributable to the Affordable Care Act? And we just don't know. I mean, there's some specific aspects of the Affordable Care Act that matter here. So the slower growth of payments to a number of providers in Medicare is a specific aspect of the Affordable Care Act that we thought would lower Medicare spending relative to the pre-ACA world, and we think has. But whether other provisions of the Act have had other or more indirect effects on federal healthcare spending or national healthcare spending, we just don't know. Is there anything else? Okay, it's been great to have you all here as always. Thank you very much.
Thank you.
Tonight on C-SPAN, two panels from the